start. Sorry, we're ready to start, I think. Good evening, everybody, and welcome to this meeting of the Pensions Committee and Board. I'm Councillor George Dunstall, and I'll be chairing this meeting. I'm going to just go around the room and ask committee members and officers to introduce themselves. Start to my left.
Patrick Eustace, the principal lawyer, legal advisor to the committee.
Councillor Tammy Hymas for St Answorth.
Councillor John Bevan, Northumberland Park.
Tyann Curran, Woodside Councillor.
Ray Pattinson, employer representative.
Steve Turner, investment consultant for Mercer.
Keith Brown, employer representative.
Ishmael O'Warish, employees representative.
Jamie Abbott, pensions manager.
Tim Mpofu, head of pensions.
Great, thank you very much. So just to make sure everybody can switch their phones off or put them onto silent to avoid any distractions, and we'll look to move on to item 1. So item 1 is filming at meetings. This meeting is being live streamed via the council's website and will also be recorded and available to view by members of the press and public. Just to go one step back, when colleagues online have anything to add, perhaps they can introduce themselves at that point. Apologies. So that was item 1. Item 2, apologies for absence, lateness or substitutions. Randy's here. No? Just Randy. Okay, thank you, everyone. Item 3, items of urgent business. No items of urgent business. Item 4 is declarations of interest. Are there any declarations of interest? No. If anybody does become aware of any throughout the meeting, please do let us know. Item 5 is deputations, petitions and questions. No, we haven't received any. Moving on to item 6, record of training undertaken since the last meeting. Is there any training that anybody has to report?
I'll send mine in.
Thank you, Councillor Bevan. This will be noted once it's sent through. Item 7.
Sorry, Chair. Just to come in on the point of training, just to note that members did receive training on ESG from B Finance as part of the responsible investment strategy. So just for the minutes.
Got that, Cody? Moving on to the minutes of the previous meeting, which have been circulated to members. Does anybody have any comments regarding the accuracy of the minutes? Can we agree the minutes of the 25th of July? Thank you. Minutes are agreed. Moving on to our substantive items. Item 8 is the LGPS update. This report provides Pensions Committee and Board with an update on several important issues related to the local government pension scheme. And Tim Mpofu, Head of Pensions and Treasury, will introduce this, after which we'll have some questions and comments.
Thank you, Chair, and good evening again, members. So I'll be introducing this paper by John Raisin, who's joining the meeting online today. We'll be talking through the detail that's covered in it. So I think for those of you who may have been following the news, it is quite an interesting time to be involved with the LGPS. there seems to be quite a number of announcements that are making the public mainstream with regards to the scheme and the future of the scheme going forward. So John has prepared a paper that kind of goes back to 2023 when we had the response to the initial consultation. For those of you who were on the committee, you remember that. And then later on, we had a letter from the minister, the then minister, on the 15th of May, just before the general election was called. And more recently, we know that the new government that have been appointed are looking at a pensions review. So this is all covered, and it seems to all be kind of flowing from the same conversations we were having last year, albeit that there seemed to be a bit more momentum this time around with the new government. So I think one of the key things just for me to highlight before I hand over to John is there is an ongoing pensions review happening at the moment. There are a number of roundtables and workshops that are being run by the civil servants at Treasury, but also within the Ministry of Housing and Local Government. And the view is that these will inform the evidence. There's, I think, about 3 key areas that the government is looking to cover. The first one is tackling inefficiencies or so-called inefficiencies in the LGPS. And the kind of overarching aim is really to direct more capital to support UK growth. So those are quite a lot of themes. You note that the pool has probably been consulting with some of you as well. You've been invited to different types of engagements. So no doubt that this will be something that will feature for the remainder of the year. So when there are any kind of significant updates, we will be providing them to this committee. Just a quick thing to flag is there was a letter or a call for evidence that was open from the 4th of September up until the 25th of September. And that was essentially asking for a series of questions, which I think John will detail in his report. So just to confirm that we did respond to that on behalf of the pension fund. As members will appreciate, the timescale was really short, 3 weeks in between a committee cycle. So we didn't have the opportunity to consult you as we normally would. But just to confirm that the views that Haringey presented were widely shared across the London LGPS community as well. So those were just my my introductory remarks, and I'm happy to hand over to John to maybe highlight any other areas covered in his report.
Yeah, thanks, Tim. Yeah, I mean, as Tim has said, this report in some ways is a continuity, because the first 2 items, the updates on the 2023 consultation and the ministerial letter of May 2024, refer to the previous government, but actually policy on LGPS between the previous government and this government appears to be pretty similar. But as Tim has said, this government seems to be pushing ahead much more at pace than the previous government. So we had the consultation in July 2023. They quickly issued a consultation outcome in November, and they indicated they were going to implement a number of reforms, particularly in relation to strengthening pooling, and also in relation to private equity and levelling up, and the role of consultancy in the LGPS, and also on reporting. You need a statutory instrument or an LGPS regulation to actually put something into effect. Nothing happened in that respect before the election, with one exception, and I'll come to that in a little while, which was on reporting, which is quite important. However, just before the election, the then Minister Simon Hoare issued a letter to all LGPS funds in England, and he was looking at a number of themes which the previous government, the present government rather, have followed up on. His first theme was, when do you think you're going to complete pooling? And his second theme was, well, what about if we consolidate funds and have fewer funds? Notwithstanding the election, the Scheme Advisory Board advised funds to respond to that, and Haringey, and I believe almost every fund in England, did respond. So the new government has an awful lot of information already waiting as a result of the previous government's requests. As we know, a new government was elected in July, and the relevant minister is Angela Rayner at the Secretary of State level, but the minister at the local government level is a guy called Jim McMahon, who I understand is a former councillor, and he has been already brought into this pensions review, which Tim briefly covered a few minutes ago. But one important thing the government has done, which I referred to here, is created a joint appointment between the Treasury and the DWP. Now, the Treasury are responsible, as we know, for the finances of the country. The DWP is responsible for private sector pensions, not LGPS. But they've appointed a joint minister there, a woman called Emma Reynolds MP, and she's a minister in both of those departments. And that's quite important, because that means that they can at long last coordinate pensions policy, certainly private sector and treasury, quite easily, which they wanted to do in the past, but they struggled to do. Just moving on to that section on the new government and the LGPS, as soon as the new government got in, they started to issue press releases at pace about pensions. And on the 20th of July, they announced a pensions review, and this referred to looking to unlock the investment potential of the LGPS, whatever that may mean, and how to tackle the 2 billion that is being spent on fees. But I would just point out that they mentioned 360 billion, and if you divide 2 billion by 360 billion, you find out that's 0.5%. I won't make any comment, but that's what it is, 0.5%. So they issued on the 18th of August the terms of reference to this pension review. Interestingly enough, it covers the DC world and the LGPS. It doesn't cover the private sector DB world. And I think the reason for that's pretty obvious. It's closed. So the government is interested in the open pensions world, i.e. DC in the private sector, LGPS in the public sector. Because of course the other public sector pension schemes are irrelevant as well, because they're not invested. So there's no money in them. So the only place there is money to be invested is in private sector DC and LGPS. And that's why clearly the government is focusing on them, because that's where they see there could be potential investment for the UK. So they announced the terms of reference, and you'll notice term of reference number 2 was tackling fragmentation and inefficiency in local government pension scheme through consolidation and improved governance. That relates back to what the previous government were talking about, consolidation and questions about governance in Simon Hoare's letter in May. And then fourth is encouraging pension investment into UK assets. As Tim said, on the 4th of September, they issued a call for evidence with a very short timescale. It was 3 weeks, and there are actually 10 questions in that, 4 of which related to LGPS and 7 which related to the DB. 1 overlaps. It was interesting about the LGPS one. They were asking to what extent it's been successful, including specific models of pooling, and how did it deliver long-term risk-adjusted returns. I think as a number of responses have pointed out, that's difficult to answer because pooling hasn't been going in the long term. If you look at most LC products, they've a life of perhaps 3 or 4 years, which is not long-term investment. So that's a difficult one to answer. They also then talked about investing in the UK and covered that in 3 questions. The first one went back to the issue of a more consolidated LGPS. To what extent would that assist? They weren't clear, not clear at all. Does that mean less pools, less funds, or both? We don't know. Then they asked about the main factors behind changing patterns of UK pension fund investment. And one thing I'd point out there is that the LGPS has a far higher investment, I believe, in the UK than the private sector does at the moment. And particularly in private assets, there's been a very long history of UK investment. And then there was this third question about, is there a case for additional incentives or requirements aimed at raising portfolio allocations to the UK? I think most people's answer to that one is incentives are welcome, but requirements are not, because that would impinge on pension fund duties to their members. Clearly, this could be pretty fundamental. As Tim said, the government are engaging with stakeholders, and they've been engaging at a fairly senior level, including ministers being involved in stakeholder meetings and very widely as well. The timing of this, we understand that something is going to be said significantly before Christmas, and something should be clearer by that stage. Just move on to some more sort of local government specific things which have happened. The annual pension report, there was some updated guidance issued. That's the one bit of the pooling consultation that was put in place, because new statutory guidance was issued in April. And that puts a number of new burdens on both the investment side and the pensions admin side of pension funds. Essentially, not for 23-24, because it was issued too late, but for 24-25 onwards, funds are required to report an awful lot more about their investment activity than they ever were before. That is particularly in relation, A, to pooling, and B, to what they're investing in the UK. And I have to say, having looked at that requirement and spoken to a number of funds, I think the actual workload for the accounting officers is going to be somewhat more than it was before. And then we turn to pensions admin, where a whole raft of new KPIs and reporting indicators are required. And again, these will, I suggest, and I'm be interested to hear what Haringey officers might say, but I understand, having spoken quite widely again, that these are quite burdensome and will require quite a lot of input. But of course, all of this will give the government an awful lot of information on which to make further decisions going forward. Bottom of page 7 of my report, I'm not sure what page it is on your agenda. I talk about LGPS account and audit. That the long-standing request that they separate out the audit of the pension fund from the general fund, which I think the Scheme Advisory Board made in 2022, and the previous government said, yes, we're happy with, but didn't actually do anything about, rolls on. There could be some good news, though, because I understand that the draft bill on audit reform and corporate governance does create a vehicle to potentially separate out the audits of pension funds from the host authority. I hope that's correct, and let's hope the government actually does it, because in Scotland and Wales, pension funds are reporting a lot quicker on their accounts than they are in England, simply because English authorities have been held up generally by their administrative authorities being subject to such lengthy audits by the auditors. This is an audit issue, essentially. Final thing I talk about in this paper is the Government Actuary Department review of the 2022 valuation. Those of you around 3 years ago recall that every 3 years the Government Actuary has to carry out this assessment of the LGPS actuarial valuations across the 86 funds. And they have to look at 4 elements: compliance, consistency, solvency, and long-term cost efficiency. The first 2, compliance and consistency, really are concerned with the approaches of the 4 actuarial firms that deal with the LGPS. And the last 2, solvency and long-term cost efficiency, are really on the approaches of the individual funds. They issue flags in relation to solvency and long-term cost efficiency, where they look at a number of metrics. The flags range from red to green. If we look at compliance, GAD are content with that. With consistency, well, GAD have an issue that they don't like the fact that the 4 actuarial firms report differently. But of course, that is within the actuarial profession's guidelines. But notwithstanding that, GAD are recommending that the Scheme Advisory Board sort of consider this issue as to whether there could be greater consistency between actuarial valuations to allow greater comparison. So that's one recommendation, and they've also recommended that the Scheme Advisory Board continue to develop the guidance on climate risk. In terms of solvency, they note that solvency has got better because the average funding rate has gone up to about 107% from just under 100 at 2019 valuation. GAD did raise some concerns also about, and Haringey hasn't done this, but some funds have transferred property assets to their pension fund. GAD don't particularly like this, so they've asked the Scheme Advisory Board to sort of look at it and make some recommendations. In terms of long-term cost efficiency, which in simple terms is about the rate at which employer contributions come in and whether they are set at an appropriate level, i.e. do they favour present taxpayers too much or future taxpayers. GAD noticed that more and more funds are now in surplus, so they're now becoming concerned about not only how do funds treat deficits going forward, but how do they treat surpluses. So they have both issued recommendations on that and said that they will be looking in the future to sort of give more view on this, and they've given a commentary on how they'll be looking at deficits and surpluses going forward. That's essentially it. I'm happy to answer any questions. Thank you.
Thank you very much, John. I'm going to open it up to the committee. Got some questions, Councillor Bevan?
Well, not questions, a couple of comments really. I mean, it'd be really good if we get these audits separated from the council audits. I mean, it's just such a logical thing to do. But one of the things I picked up is some councils choose their actuaries because they know they will use different assessments of lifespan and all this type of thing. So, because a council said to me when I was somewhere, we choose this actuary because we know our surplus will come in higher because they're going to use more favourable assumptions of lifespan and all this type of thing. So I know the government's seeking a common standard that actuaries will apply the same standards, all of them will apply the same standards to their work, which seems logical to me. I mean, I would assume you would be supportive of that because it seems a bit fraudulent that, you know, what's going on.
But I mean, the one thing I can say, and the one thing that's clear, is that all the actuarial firms are operating within the guidance of the actuarial profession for the, you know, the Institute of Actuaries. I don't think there's any question that any actuarial firm is acting in any way whatsoever improperly. Different actuarial firms use, you know, slightly different assumptions, the way they value liabilities, but they are all within the guidelines. It's just as accountants use, you know, different accounting firms use different approaches. You know, if some councillors or officers in other funds are making those comments, well, I would take them with something of a pinch of salt. The fact is, yes, different actuarial firms use different methodologies. Whether they necessarily lead to higher or lower funding levels, I'd like someone to, you know, to prove that. I really do doubt it, because if you look, and I've not got statistics in front of me, but I've looked at the actuarial levels and the funding levels of different funds, and it isn't that easy to see a pattern between what any actuary does. That you know, actuary A is giving everyone a very high funding level, and actuary B is giving people a lower funding level. I don't think that comes out. So I'm not so sure. I mean, some people may believe that, you know, a particular actuary gives them a. There was one actuary some years ago who people claimed gave you a higher funding level. Well, that particular actuary, I know at the moment, certainly doesn't seem to be able to step. So I think there's a lot of talk, but not a lot of evidence about this one. Personally, that's my view.
Thank you. And Keith.
A few years ago, I've been out of date on this, but it was kind of generally known in the business which actuaries were using which discount rates. And there were minor differences in the discount rate applied. And the main source of that was whether the extent to which they were incorporating corporate bonds rather than just government bonds. Now, I don't know, that's, you know, some years ago, but I don't know the current situation. But it does happen. The industry generally knew who you could go to or which actuary would give you the best results.
Thank you. Any further questions for John, Councillor White?
Thanks. So this was just to note really on the section in your report, John, on the new government and the LGPS, because I was at a conference organised by the LCIV a few weeks ago, and there were a few voices raised in concern about the prospect potentially, and a lot of hope that this wouldn't be happening, but the prospect that the LGPS would be being used as a kind of sovereign wealth fund to kind of, you know, get growth in the economy, because that's obviously a key priority for the new government. So I mean, I know you've spoken on this already, but I just wanted to kind of note that there were quite a few voices raised in concern about that at that conference that I was at.
Well, I think there is a concern, Councillor. I think the probable concern is that the LGPS is well funded. So the average fund's 107% at last valuation, potentially higher at this valuation. The LGPS has really two duties, I think. One is to its members, but in some ways the duty to the members is covered for them because member benefits are guaranteed, but they do have a duty to the employer. And employers, all LGPS employers, be they councils or non-councils, are under tremendous pressure. And I think the real concern is that anything that diverts or pushes LGPS funds away from thinking about how do we minimise and mitigate the terrible pressures there are on employers. If anything mitigates from that, then there's a problem. And the way the LGPS has been managed over the years it has been with that in mind to try to minimise the burden upon the employer. And the LGPS has been very good at that. I mean, the average employer rate in the LGPS, I think, is about half that it is in the unfunded schemes, i.e. the unfunded public sector schemes. But if there was any sort of pressure to invest in certain elements or certain asset classes, simply because government wanted it, then that could be a poor investment decision. So I think that last question, if you recall, about incentives or requirements, everyone would welcome a genuine incentive to invest in the UK, because it would help funds to invest in the UK and help the government to achieve what it wishes. So if there were some genuine tax breaks, for example, only for UK investors, because if you offer them for worldwide investors, again, that would just bring too many people in the market. If there was a genuine tax break, that probably would be welcome. But if there was some sort of target, or even informal target, like the last government was talking about, if you remember their ideas about private equity, I think that would be not welcomed by the LGPS, because that's not the role of the LGPS. Government policy, rightly, government is in charge of economic policy. LGPS is in charge of delivering pension benefits at the least reasonable cost to the employer.
Thank you very much. Any further comments or queries for John on that? No, I just had one, John, if that's all right. Just next to that point, actually, on your report, page 7, where it talks about reporting on ESG activities. You may not know at the moment, but I'm just wondering, what might that look like, and how burdensome might something like that be? And I guess also there's a bit of context with the RI policy considerations and that sort of thing as well.
I don't think the ESG one is particularly burdensome, because the last time in the previous guidance in 2019 said that you may, and a lot of funds did start to report then in detail. So in 2019, the government introduced it as a may. They've now upgraded it to a should. So, but it's already there. So there's already been lots of work done by funds. I think the ones which are really burdensome are the ones which I referred to about incentive pooling in particular ways, how much you've invested in the UK, etc., etc. Those are the more burdensome ones, and the ones which were not there at all, and which I think have been put in there. And remember, it came under the last government, but this government's carrying on the same policy of identifying exactly what funds you're investing with and where. The only thing I would say is that I think the government might be surprised at how much UK investment there is by the LGPS already.
Great, thank you very much. And we'll draw that item to an end, and we'll move to the recommendations as set out on page 9, paragraph 3.1. This item is to be noted. Moving on to item 9, which is the Haringey Pension Fund Draft Annual Report for 23-24. This report represents Haringey Pension Fund Annual Report and unaudited accounts for 23-24, and is for approval. Tim will introduce this, and I'll hand over to Tim.
So I think Taryn will introduce it this time around. So I'll hand over to Taryn.
Thank you, Tim. Thank you, Chair. So as you say, what we're presenting tonight is Haringey's annual report for 23-24 and unaudited accounts. I would emphasise that this is the position as at the 31st of March, and we're now 30th of September, or almost at the end of September. So there are quite a few reports that we've got later on as we go through the agenda that gives a more up-to-date picture. So I would just talk through a couple of the highlights, but also direct us to future agenda items where I think it would be more appropriate for us to look at the latest data. So in terms of the annual report, so there is a requirement for us to publish by the 1st of December. So it's coming to, as we say, to committee, to board for approval. What would usually happen, and it's already been touched on briefly in the previous item, is that the annual report would go up with the audited accounts for 23-24. So we picked up on it earlier. We know that it's particularly challenging in the external audit sector at the moment. The strong likelihood is that the annual report will still get published on the 1st of December, but it will be published with the draft pension fund accounts for the reasons that we've said that they can't be separated from the general fund council account. But we will then republish the annual report once we get a final set of accounts for the pension fund. So the main annual report really starts on page 31 of the agenda pack. And I suppose there's a couple of points that I would just draw to your attention in terms of kind of what's included in the annual report, because it's quite a key document, I think, for the pension fund. So it's quite a lengthy document. It's quite prescriptive. There's certain things that we need to include. And we will also do some more some different communication and summaries that would go out to essentially employers and members. So this is very much a standard document that we need to do. So as you can see on page 33, the reports, and it is a position statement for the whole of the year for 23-24 in terms of our management and financial performance, our investment performance, our scheme administration, the actuaries report, and the accounts as well. So on page 34 to 36, essentially this part of the report just picks out a summary of our governance arrangements and our approach to risk management, but also some key membership stats. And you can see that actually the membership of the pension fund hasn't changed significantly from the previous year, but also the mix of membership in terms of how that's made up against the different cohorts hasn't changed significantly. But when we come onto the financial administration paper, you'll see the latest information as at the end of June. In terms of investment, so Pensions Committee and Board has already agreed its investment strategy, and page 39 of the annual report sets out a snapshot in terms of investment page 39 onwards sets out an overall snapshot in terms of both our asset allocation and our performance. And I suppose it's just a reminder to the committee and board that 78% of our assets are pooled with the London SIB. So just a reminder on that. So in relation to investment performance, and I'm sure we will talk a little bit more about this on the agenda as we go through, you can see from page 41, I hope it's 41 of the agenda pack, where we report our performance against the benchmark, and you can see it's quite a mix. There are areas where that we have performed above the benchmark, but there are also areas where we have performed below. So we can certainly take some questions on the reasons why, but I think we will come on to that in a future agenda item. A topic really important to the committee, page 42, picks up on our approach to responsible investment. But again, this is a snapshot in terms of where we were at the end of March. We've got an agenda item coming up shortly where I would just encourage us to kind of look at the latest position in terms of what we are doing on that space. Finally, or last couple of items, so page 45 onwards in the pack sets out our key performance indicators. You can see in the table there that there are some areas where performance is slightly below where we would want to be. I would encourage us to save any questions for agenda item 10, which shows the latest performance, and it does show a marked improvement from what we're seeing at the annual report. And I think final section, which is probably the most lengthy section of the annual report, is the unaudited accounts. So they are typically and traditionally quite long in length, and what you've got there is the accounts as they stand at the moment. I suppose what I just would echo, and I think it's on page 69 of your pack, is the section around in the accounts around risk management, and in particular how we manage our risks and some of those that we were experiencing. You know, I think for me the reality is that we are facing risk all of the time. It's going to be impossible for us to alleviate it completely, and we will see that particularly in terms of our investment performance. I think that is really critical. I think for me the importance of sensitivity analysis, scenario planning, and just you'll see later on in the report we've got our latest risk register, just ensuring that when you're in a world where you can't alleviate risk altogether, that you've got the confidence that we're taking all the mitigations that we can. Anything from Tim?
Does anybody have any questions for Darren? Sorry, Councillor Bevan, yeah.
I must say this is a very comprehensive report. I know it's a standard format, but I think it's quite impressive. One question I would ask, the management fees, so the investors' fees to the investment managers, and the staff admin fees within the council. They're quoted separately on page 38 and page 60. I was interested in getting that as a percentage cost of the overall fund. So the fund is valued at 1.8 billion approximately. Is it permissible to put in this report, show these costs together in one place and as a percentage of the overall value of the fund? Because I would find that very interesting, but I do appreciate the percentage would change as the fund sort of changed over the years. So it'd have to be done at the date it was published.
I'll just come in briefly, and then Tim may want to be added. Let us take that away. I mean, this is a draft report. We'll just check the guidance that it's not prescriptive in terms of how it will be. It needs to be presented, and we can certainly reflect that if we can in the final version. But let's just take away just to make sure that we absolutely can. But I guess what it doesn't do is it doesn't stop us still sharing that figure and that percentage with the committee and board at a future meeting. We may not be able to include it within the annual report, but there's no reason why we can't say include it in the final end of year financial admin report, for example. So let us take that away about how best to provide that to the committee.
And then I do remember in the previous year we were told that the fees from all the investment managers were quoted here, that there were some hidden fees that we weren't aware of and would never be aware of. Is that still applicable, or has that been resolved?
Yes, I'll come in there. So I'm not sure about hidden fees. I think what had happened last year is the government is going to exercise, or the Scheme Advisory Board called the cost transparency, and they started releasing those reports. But a lot of those reports actually double count the fees. Those are fees where, for example, when the manager is transacting, they will incur some fees. But what we actually pay as an investor is what we've agreed in the investment management agreement. So I think in this guidance that the Scheme Advisory Board has issued, it does specify how those fees should be accounted for, because I think across the schemes, it was inconsistent with how people were applying that. The reason behind the cost transparency, and they're actually quite helpful, is just you don't receive the reports in a timely fashion, and we do look at them quite regularly. It does show some of the areas where fees are being driven that are affecting performance, but they don't actually affect the overall investment that Haringey is being charged for managing those fees. So I think there's just like greater clarity now in terms of what we're using, and we're more using the investment management fees rather than the cost transparency, which would be sort of double counting.
Great. I've got Councillor Hymas and then.
Yeah, my question is obviously about the council's wider financial position. And I know that we recently had a paper come to cabinet around the £20 million black hole. I wonder if you could just outline ways in which the pension fund might draw down or is drawing down on the general fund. Thanks.
So they are two very separate accounts, separate funds. So there are two areas essentially, I suppose, just to pick out for you. One is that so the cost of the team. So the cost of the team will be partly funded by the pension fund, and to some extent for some posts. So I don't want to talk about individuals in particular, but not everybody within the pension team works solely on the pensions fund. So there'll be a little bit of movement in terms of charges between those two funds there. I suppose the second is the employer contribution. So that is reviewed at every triannual evaluation. So that was last in 2022. So that will next get updated at the next valuation in 2025. So I suppose in terms of the immediate impacts, there isn't. Those are those two areas. So it's very, very distinctively separate. But, maybe we'll review employer contributions at the time of the next valuation, but that very much depends on where we are with the fund and also the advice of the actuary at the time.
Yes, I think just to add that's the key one. The key relation really is to the employer contribution. But when those fees are being set, it's looking at the fund level. And obviously Haringey is the biggest employer. I think it's about 70% of assets is Haringey Council. But there are a number of employers with different funding levels within the scheme. So that will all be taken into context. But certainly if the funding position is as healthy as it seems, then there'll probably be a discussion to be had about what contribution rates should be looking like to remain stable.
Great, thank you. Councillor White.
Thanks, Chair.
So just referring back to John's report under the previous item, and the new guidance that says that for annual reports covering 23-24, funds should use their best endeavours to comply fully with this new guidance. Have we made any big changes to the report, this report?
No, so for this iteration of this report, we've not made any big changes. I think we've just made the changes that are sort of easiest to implement, given the time when this guidance was issued out. So I think a lot of the work that the Scheme Advisory Board is asking for was already in the report. So they want a bit more consistency. And one of the key elements of that guidance that came through, which is why they wanted to publish it, is to allow funds to publish the report without it being an audited set of accounts. I think that's probably the most meaningful change that they've included within that change. So that allows, I think we've already been doing that informally, but now it's a formal part of statutory guidance for the fund to do so, hence why we brought it to you on this date, so we can make the 1st of December deadline. But there are a number of things that are mentioned in there in terms of KPI reporting. So certainly the KPIs that Taryn pointed to, we haven't changed those, but you will note that the ones I'm in Jamie are much more detailed and will go into future iterations. Same with how we show our investment income and the ESG type stuff. We haven't really incorporated that. Hopefully, once we've completed the RI, it makes more even easier for us because we have those targets that we can report against. So I think the report will still be quite good for what the Scheme Advisory Board want to do, which is to come up with a scheme-wide valuation and how is the scheme performing, what is the total fees. The ones you see being quoted in the news, they come from kind of the aggregation. But yeah, I think some of the other things like the smaller detail, we haven't had the opportunity to fit those in, but they will make it into the next versions of this report.
Great, thank you. And Councillor Ingaran.
Thanks, Tim. Coming to page 45, one of the key performance indicators is the administrative costs per member. Do we have a benchmark of our administrative costs compared to maybe other schemes?
Yes, so we don't have it on hand, but I can prepare that for members. So normally what we use to benchmark is what they call an SF3 report, which is kind of slightly different to how we do it, but all local or government pensions are required to report on this. So the deadline for that was actually middle of this month for all of them to submit. We expect the report to be here before the end of the year, so I'll be able to see how Haringey compares. And I think at this point, I can't really comment without having had a look at that data.
Great, thank you. Yeah.
2 questions, please. Firstly, where do we document the representations that we've received and our responses? And secondly, where do we document the actions we're taking around lost pensions? So where we know pension eligibility has been arrived at, but we haven't seen any claims on it.
So I'll come in on the first one in terms of the responses. So these are, I'm assuming, the FOIs or any deputations we've received. Is that what you're referring to?
Yeah, it's a Palestine environment. We've received them. Where do we document that they've come and our response?
So they are all within our files at Haringey. We don't necessarily have a public portal of all the responses. I do think there's a public website where all FOI responses are shared. But certainly when we've had like deputations and stuff like that, we haven't shared it any wider than whoever's requested the deputation. In many instances, those questions are quite specific as well to the group that's asking that. But yeah, that information is readily available on our shared drives, and we can share with members if you'd like to see some of those responses for if that would be useful.
Second one about lost pensions.
Yeah, so again, we have that information to hand. If members want to see it, we can provide that to members.
I just would have thought from a regulatory perspective, it would be expected of us to be able to demonstrate that we're being proactive in trying to make funds available to people that they're eligible for it, and how we've done that. That's the motive behind my question.
Yeah, so we have been quite proactive. So we've done the data cleanse project. So we basically tried to locate members who we had old addresses for, and that has been quite successful. So you see on the pension admin update, the number of deferred members are going down, and that's because due to the data cleanse, we've got more contact and we put more pensions in payment that previously we couldn't do due to lack of address and contact.
Yeah, and I think to add to that, the government is currently working on the pensions dashboard, which is set to really address all that. At the moment, unless if someone actually does come to us, if we have a record for them, we can obviously follow up with them. But if they have a record somewhere else and they're not aware, there is no real way of communicating with that person if people have moved. So the idea around the pensions dashboard is you'll be able to use an identifier such as your NI, and you'll be able to see a list of all your pensions. So I think Jamie and the team are currently working to make sure that we're going to be compliant for that. When that's launched, I'm not sure when the date keeps on being moved. But yeah, we've already been undertaking that work. So yeah.
Any further questions or queries? No. So we'll now move to the recommendations as set out on page 27, paragraph 3.1 and 3.2. This report is to note and to approve. Can I see those in favour of approving this? Those against? And any abstentions? Nope. Great, thank you. Moving on to item 10 is the Pensions Administration update, and this report provides the Pensions Committee with an update regarding pension funds administration's activity. I'll hand over to Jamie Abbott, the Pensions Manager, to introduce this, and then we'll have questions and comments.
Thank you, Chair, and good evening, everyone. So I'll be providing an update on the Pensions Administration function as at the 30th of June 2024. So we'll cover 5 points: the pension fund membership update, the update on the online member self-service portal, update on the service level agreements SLA statistics, update on the annual benefit statement exercise, and an update on the scheme member engagement. So firstly, look at section 6.2, table 1. This provides a breakdown of the membership in the Haringey Pension Fund as at the 30th of June. As you can see, it's quite consistent. The only kind of key change would be the deferred members, as mentioned previously. They continue to go down, and that's because we've done a lot of data cleansing and put a lot of deferred pensions into payment that we couldn't do before, as well as locating where members have moved on to other funds and processing their transfers out. In section 6.4 is table 2, shows the update on the online member self-service portal. So again, as you can see, it is consistently going up, and we kind of hit a bit of a milestone at 25.25%. When we first started recording, I think it was like 7-8%. So it really has been a good increase. And we don't really have a target of where we want to get to, but I think as long as the number keeps going up and we're kind of constantly engaging members to go online, I think it's a success. So it's kind of been fueled by our kind of online first approach. So when members contact the pension team, we do try to direct them to the online portal so that they can run their own estimates, view their benefit statements, and kind of makes a less of a burden on the team to free up our time to focus on other kind of administration functions. And again, it has been a success, as you can see by the percentage going up. Table 3, section 6.5 shows the kind of total number of members who access the portal over the last 7 days, 30 days, 2 months and 3-month periods. So we can't directly affect these members. It's just as and when they want to access the portal. And the numbers shown there are like cumulative, going down in order. So I have a quick break there for any questions before I go on, or
any questions for Jamie? No? Okay, carry on.
Perfect. So we'll move on to probably the more interesting part, the update on the service level agreements SLA statistics. So I'll draw your attention to table 4, section 6.8. As you can see, there's a new section, a new column on the table showing the change and the movement of the SLA. It's kind of give members a more visual representation about how we're doing compared to the last quarter. So key things to pull out here is the improvement on the transfer SLAs, quite a big jump on the transfer in quote. That's because within the team, we've kind of focused more on those SLAs and those caseworks, because last time we had presented, you can remember they were kind of the lowest ones. But as a consequence, unfortunately, other SLAs kind of dipped a bit. So the estimates and retirement quotes, but not below to an SLA level that would be concerning. So there's been a slight dip, but not a huge one. And then, yeah, refund actuals have remained the same. And I'll kind of stop there for any questions about the SLAs and how the team is performing on the administration function.
Any questions or comments for Jamie? No? Happy? Councillor Bevan?
Can I just ask about the staffing? Because we had 2 apprentices, I think, was it? Am I correct?
You are correct. Yeah, we had 2 apprentices join the team.
I just wondered how they're getting on if they haven't given up.
Not just yet, thankfully. No, they're doing really well. So they're well as receiving in-house training on the LGPS and the admin function and how to process the casework. They're also receiving external training on the general kind of overview or landscape of pension schemes, how they're made up, the governance, which is quite important. But yeah, I think they're quite enjoying it. They haven't left yet. And yeah.
Great. Thank you. Any other questions or comments? Nope. Jamie?
Thank you. So next update is on the annual benefit statement exercise. So Regulation 89 of the LGPS Regulation 23 requires that administrative authorities issue an annual benefit statement to active, deferred and pensioner members. It specifies that the annual benefit statement must issue these within 5 months of the end of the scheme year, which is the 31st August. So as part of our exercise this year, we did redesign the template for the deferred members, try and make it a bit more easy to understand and a bit more user friendly, as well as preparing quite in-depth notes for the active statements. So again, make the members more aware of what's on the statement, how to understand it. So after we've done a lot of data cleansing for our scheme members, we produced and distributed the statements online for the active members via the member self-service portal. And for the deferred members, we sent them out via the post.
Any questions or comments for Jamie?
And lastly, section 6.12, update on member scheme member engagement. So in September 2024, between the 9th and the 15th was the Pension Awareness Week. And we thought within the team, it would be a good chance to engage with our members. And we ran a workshop on the 11th of September. And it was quite well received. So it had about 100 members of staff join the team presentation, as well as after we set aside time to do one-to-ones with members, could talk through their particular pension queries. And the training was recorded and distributed, and we had about another 30-40 members after request access to the recording. So all in all, really well received and kind of forms part of our communication policy to really engage with members.
Great, thank you very much. Any other questions? Councillor Hymas?
It's not a comment, but just to first congratulate the team on the nomination to the Local Government Pension Scheme Awards, and good luck ahead of the event on Thursday.
Thank you very much. We'll let the PCB know how we get on. Fingers crossed. Yeah.
Great. Thank you very much. So we'll move now to the recommendations as set out at page 79, paragraph 3.1. And this report is to be noted. And we'll move on to item 11, which is the responsible investment update, providing PCB with ongoing responsible investment development and implementation work. And it also provides a local authority pension fund forums engagement update. And I'll hand over to Tim.
Thank you, Chair. So this agenda item is a bit of a new item, but it's also a hybrid. So those of you who may have been paying close attention will realize that there is no LAP update this time around. We've changed it to the responsible investment update. That way, it kind of does broaden the contents of the report, not just kind of the work of LAP, but also the work of the fund that we're currently underway. So we've tried to incorporate both those things into a singular report. And as more of the work on RI develops, I think we'll be adding more information to this report as well. So I think at this stage, I would welcome any feedback from members in terms of what you think is helpful information to be included, or what is information that might need to be omitted. So in terms of the paper itself, you may be familiar with this. It just goes through the key outcomes that have been identified for the RI development work. And on table 1, which is on page 84, we've just summarized the work to date. So the introductory section was completed. The educational session on ESG was also completed this month. And hopefully all of you would have received a link now to the questionnaires. I think that came out on Friday. If you haven't received a link, please do let me know. Be happy to forward that on. And we're really asking members if you could spare, I think it takes about 20 minutes, I understand, to go through it, to complete it by this Friday. And that will inform the next session, which is due on the 21st of October, where hopefully we'll be discussing those outcomes and going to the next stage of what that actually means for the fund and also for the RI policy itself. So that's just summarizing that kind of piece of work that the fund is currently undertaking. In terms of LAP itself, so the reports, strangely, this time around, they hadn't published their quarterly report, which I normally use as kind of background to developing this. So there isn't really much to share in terms of their engagement activities. They did issue quite a number of voting alerts, quite a lot of them, actually 20, but they're all kind of related to, I think, investor issues around scope 3 greenhouse emissions, to kind of varying degree depending on the specific companies. So we've not been able to collate all that information for this report to include how they voted. But I think if members are interested, I can provide that separately. It is quite a lot of work to sort of go through all the 20 and figure out how LGIM has done. So again, I would welcome any feedback, especially given how important that is in terms of the engagement of the fund, or demonstrating how successful that engagement is, whether there's any alternative methods of also showing the progress that the fund is making on those matters. So those are the key things to highlight for this report, and happy to open up to questions.
Great. Any questions or comments for Tim on this? No? I think we're okay, Tim.
That's good. Yeah.
We'll move to the recommendations as set out page 83, paragraph 3.1. This report is to be noted. Moving on to item 12 is the Haringey Pension Fund Risk Register. This paper has been prepared to update the Pensions Committee and Board on the Pension Fund's Risk Register and provide an opportunity to further review the risk allocation score. And I'll hand over to Jamie, the Pensions Manager, to introduce.
Thank you. So I'll be updating on the Pension Fund Risk Register. So firstly, I'd like to draw attention to section 6.3, mention of the appendix 1 of this paper that provide the assessment of the investment related risks that have been reviewed and updated by the senior fund officers for the PCB feedback. So yeah, we're going to focus on investment risks on this paper. Section 6.5 shows that we've added a new column on the risk register, same as the SLAs. So we now have directional indicators for each risk, comparing them to the previous assessment. And these show whether the risk is improving or worsening based on the relevant factors, and each symbol kind of shows which way we're going. So a red arrow pointing down, it means the risk is getting worse. The total risk score has increased. A little yellow line means that it's remained the same. And the green arrow pointing up means the risk is improving, so the total risk score has decreased. And it's a bit confusing if you think about it, but green is good, red is bad. So I'll quickly cover the key risks and go move on to the investment risks on the appendix 1. So in section 6.6, table 1, we still have the main key risk, which is ACC1, the delay of publication of statement of accounts. As covered previously, we have published unaudited account for the 23-24 period, and the external auditor, KPMG, is currently underway. We have the other significant risk, the IMV1, the significant volatility in financial markets. So the financial markets have become more volatile in the past quarter due to geopolitical and economic uncertainty. An ease in monetary policy from global central bank due to lower inflation rates and slowing economies is anticipated. And the fund diverse portfolio aims to offer long-term diversification benefits to offset those risks. Other key risk is IMV3 ESG risk, which Tim's covered previously. So with the fund is facing increasing call from various groups urging the PCB to review its responsible investing policies. So the PCB is currently undertaking a thorough review of its responsible investment approach, with intention of establishing a framework for managing responsible investment issues. And the first of a series of workshops was conducted in September 2024, with more to follow. So I'll move on to Appendix 1, looking at the investment risks. So they have remained wholly the same apart from 2. So IMV2, the increasing risk of a financial downturn due to rising cost of living and global central banks increasing base interest rates. That risk has improved. So the score has decreased from last time, and that's due to the likelihood being put down. Then there has been a negative move on IMV9. The implementation of proposed changes to the LGPS broadly required the fund to adapt its investment strategy. That risk had increased, and again, that because the likelihood had gone up. With the kind of talk of the new government about mergers and pooling, we believe that's more likely to happen, which is why we've increased that risk. And now I'd like to stop for questions on the register or any of the key risks.
Thank you very much, Jamie. Really helpful. Any questions or comments on that? Nope. Nope. Okay.
So maybe if I come in just with a couple of questions just for us there really from members. The first one is obviously we've now incorporated the change that shows the directional travel of the risk. So just is that helpful the way that's shown, and does that help in the assessment of this? I'm seeing nodded, so I'll take that as a yes. And then the second one really I think is maybe picking up on the comments made by Craig in terms of how this risk is done. So this is a responsibility for the committee and board. Obviously, as officers, we make a first stab at it, but the scoring really is down to members. Is there a more, I suppose, useful way for you to keep on top of this risk, or are you happy with the existing arrangements where we score and you sort of challenge us on the scoring that we've kind of provided? Maybe one thing that I can look to discuss with Code is whether a SharePoint site of sort can be set up. We can put those responses onto that site, but also the risk register can then be regularly monitored before the meeting. And any key mitigations that you think we might have overlooked might be helpful for us to consider as well. So I'll just putting that out there for views and thoughts on whether that'll be helpful.
Any comment, Ty? Councillor
Yeah, just a question on how often we review these risks or re-rate or re-rag or re-rate the risk. Is there a differential here because all of them are reviewed on the on this table on the same day? Would you not have a differential saying that actually the reds we should review more often, the amber different, green? Maybe, you know, I'm just thinking why you wouldn't differentiate the risk and rate them and review them at different times.
Yes, so I think we are consistently reviewing these risks. So I think this is more for reporting purposes in terms of before we present it to the committee, we do another check of all the risks. But as they're happening, if something changes in the market, we'll review that risk, see if our mitigations are still appropriate. But for the purposes of reporting, we just say that this is the last date that we can confirm. Like, for example, if news came out last week that interest rates have changed, we wouldn't be able to capture that before the minutes are sort of published. So I think that kind of speaks to my point that there are essentially a number of tabs. It's a big spreadsheet that has a number of tabs, and every now and again, myself and Jamie, we're going in there making iterations based on things that are changing. But whether that would be helpful for members to have access to that tab as well, and maybe make suggestions, just sort of putting that out there if that's something that you think would be helpful, or if you're happy, we're more than happy to continue doing the way that we're doing and presenting it to you. I think we are easy either way. It's just to make sure that you are still getting the benefits that you're supposed to from monitoring the risks of the fund.
Any thoughts, comments, Councillor White?
Thanks. Yeah, and just to say, I do think that the way that the risk register is set out now is definitely an improvement to what it was a couple of years ago. It's a lot clearer. But just on the INV3 risk, where the impact is rated at 4, and then it mentions reputational risk, and I'm just wondering, are we treating reputational risk, whether that's to us as committee members or the council, as at kind of the same level as the risk to the risks to the pensions of our scheme's members, and or are we saying that the reputational risk therefore causes a knock-on risk to our investments, or conversely, are you maybe saying that there's a risk, although this doesn't seem to be stated there, that the pressure from external groups will cause us to make riskier investment decisions? So I'm not sure if that's entirely clear, but I'd also not really want to be seeing kind of our reputation as individuals being treated as on a par with the risk to the risks of the pensions. Basically, I think that's what we should be focusing on here, really.
Yeah, so in terms of the assessment of all those risks, they're based on the fund. So it's the fund's risk, not necessarily Haringey councils or individuals on the committee and board. It's the risk that the fund, by taking on a course of action, could result in negative performance. So I think on that particular risk, we're pointing out 2 things. The first one is investment performance. If you're invested in companies that, for whatever reason, have bad ESG outcomes, it could be, holding oil companies and they continue to lose value. That's going to have negative performance on the portfolio. Or in the fact where maybe there's been a fraudulent case and there's poor governance in place, that also has an impact on the investment value of a fund. So that's where that assessment is coming in when it comes on ESG. But we can't move away from the fact that there are reputational issues, particularly on the social issues, where a fund might be seen to be supporting a cause that might be detrimental to its reputation, what the fund stands for in terms of its values. So I think that risk tries to capture both. So the predominant aim for members is to invest in, that's the primary sort of reason to invest, to make sure that you're able to pay pensions. But pension scheme members might have a view that they don't want their funds invested in a particular way, and that has to also be acknowledged. So it's how we are managing all those risks. So I think primarily on the reputational one, the responsible investment strategy will provide a framework for both of those things. One, are we still being able to invest in a way that's consistent with fiduciary responsibilities, but also are we taking sort of consideration of the wider issues associated with those investments, and how do we then manage that, or how do we engage with those parties that are being involved in that?
Thanks, Tim. Just maybe perhaps we could expand the text a little bit so that we're not thought to be treating our own individual reputations as members of this committee as kind of on a par with our fiduciary duty. So our fiduciary duty has to come first, and what we can't be doing is taking decisions that are aimed at improving our reputations at the risks of the pensions of the members. Thanks.
Yeah, no, that's a good point. Well received as well. So we'll make an adjustment to that wording to reflect your comments, Councillor White.
Great, thank you. I would just add that I mean, obviously, only on my second meeting of this, but I think the risk register is very clear. Personally, I find that the changing the up and down, the measured change a useful mechanism. I don't have any particular kind of suggestions in terms of change. The only thing that might be useful is if, where risks have been identified as changing, they feature just as they're not going to be a key risk necessarily, are they? But maybe in that table, so that there's a bit more explanation as to what the thinking was. Any other questions, Councillor Hymas?
Do you have a written down methodology for how you calculate the risk numbers for each category?
Yeah, I think it's in this report, actually. Let me see if I can find it, unless we removed it. Yeah, so essentially on the risk scoring, well, I think it highlights how the risks are sort of ranked or rated, what makes one red and amber and green. But in the actual spreadsheet itself, or the risk assessment, how it works, it's more kind of a multiplication. So you're multiplying the impact plus the likelihood, and that gives you the initial score. And then you do all these controls and mitigations, and hopefully it improves if it's one that you can treat. But if it isn't, then it sort of sometimes stays the same. But basically that's that. But would it be helpful if we were to put that into the report as well, say that's the methodology?
Yeah, I guess I mean more about like how you would calculate, say, the impact of a particular risk, or how you would calculate the likelihood of that risk. Is there a distinct methodology that you follow, or is it more that you sort of use your experience as pension administrators and officers to decide what you think is most appropriate?
Yeah, so it's the latter. So we'll use mainly our experience, and also any other factors. We also sometimes, before we complete this, we check to see how those are being scored by other local authorities. Maybe there's some things that we're missing, and in some instances we've seen that other local authorities have included risks with different score, and they've got different mitigations that we might not necessarily have in place. So that makes us reassess our own kind of impact and likelihood as well. For some specific risk, you can actually quantify them. For example, I think risk IV and IV8, that kind of talks about underperformance. So you just calculate the value of the fund and you so those things are varied, but mostly it involves us having a discussion internally and deeming what we would consider would be appropriate.
Yeah, I guess I just think it might be useful. So for example, for like likelihood, it might be useful to understand how exactly 1 to 5 is. So for example, are we going to say that 5 is something that is certain to happen in the next 2 years versus 1 being like a 1 in 100 event? And perhaps the same for impact. Could we have the most serious impact being I mean, I can't think of something off the top of my head, but I think maybe just clarifying that in the paper would be useful, just so we can get a slightly different perspective on what 1 to 5 actually means in your head. And obviously, like if you were to leave, then we don't want that experience to be lost and not to have the kind of structure in place that a new pensions team could pick that up quickly and be able to like use their experience and also a methodology to calculate risk.
Yes, I think that's a very fair point. So yeah, we'll take that way and see how we can build that into a framework that is consistent over time.
And just really to add to that, because there is an element of judgment involved, I think that's probably where certainly us as officers are looking, for the committee and board to challenge and, question some of those assumptions so that, it's not just based on our own expertise, that you've had some input. So, that's a really good example, I think, where actually, asking us those questions about what's the rationale around the score is kind of probably what we would really welcome from the committee. And it may be that we just want to every committee deep dive into a couple, because there is quite a number of risks on the risk register, that actually we identify a couple each time. So we have a general update, but then we perhaps have the facility where we do deep dive into a couple of really specific ones. But yeah, I think the judgment is the exact point where, please do, the committee, ask us the questions about the judgments that we've made, because that's how we'll get to the best risk score, should I say. Yep.
Great, thank you. Any further questions, queries? No? Happy? So we'll move to the recommendations as set out at page 87, 3.1. And that report is to be noted. Moving on to item 13 is the forward plan. And this paper has been prepared to identify and agree upon the key priorities for the Pensions Committee and Board over the upcoming months, as well as seek PCB's input into future agendas. And I'll pass over to Tim to present that for us.
Thank you, Chair. So again, just to update on this is a standing item. We've made just a few changes this time around Again, I think because there was an appendix we used to attach, and yeah, it never really used to change very often. So we've tried to change it this time around. Hopefully, communicates a bit better information. So the first table really is around the key priorities, which I think all members will be familiar with. The first one is to set the responsible investment objectives, and again, that's been highlighted. It's currently in progress. And then there's the fund governance review, and also that is in progress. I think we might be in a position to be able to present that at the next meeting. Not John is on the call, but I think he's working towards that deadline. So hopefully we should have an update on that in December, at the December meeting. And then there is investment opportunities review. Again, I think when we have a discussion later as part of the exempt agenda, we can maybe touch on that and what some of the ideas might be going forward. But we've just kind of put that in there as in the initial stages of development, as we're still having discussions with Mercer and with John Raisin as well. And then on the knowledge and skills, there's two things really to highlight. The first one is that the fund does have a policy on training. So some of the training sessions that we put up have been consistent with that training. There is one on LOLA, which is the LGPS Online Learning Academy. I think we do reference it quite a lot. And what might be helpful as an action is whether we set up a quick session just to show everybody how the website works. It's all self-directed study at your own pace, at your own time. But they are Hymans are consistently updating that portal, and it does offer some kind of good information around how the ALGPS is evolving and any of the kind of topical items that are coming up. In table 2, this used to discuss around kind of training opportunities that are coming up. These are externally funded training opportunities. So the first one is the LGPS fundamentals training that is hosted every year. Again, just bring that to members' attention. If you're interested, if you could just drop me a note. I think a few members attended last year, and hopefully it was quite helpful. Do let me know if anyone's interested. It does come with a cost, so we'll be looking for a commitment from members to be able to attend. And then I've also highlighted just the workshop we're having on the 21st of October on responsible investment. In table 3, that's now discussing the upcoming conferences. So I know a few members have expressed interest, but again, just widening up now to members, and maybe we can have a discussion about that now. Is that there's the LAP conference, which they do annually in Bournemouth. The dates have been listed on there. I believe we have 2 spaces. So if there are members who are interested, I think last year it was Councillor Bevan and Councillor White who attended. But if there are interest, sorry? 2 years, yes. So yeah, so I think again, just to highlight that conference is still going ahead if there are anyone interested in attending that. And then the final one is also the LGA annual conference. That also happens in Bournemouth, would you believe, but in January. So they haven't actually fully published those details, but I'll put the dates on there in case that's of interest to anyone and you want to mark your diaries. So yeah, I think those is the update, and happy to open up for questions, Chair.
Great, thank you very much, Tim. Any questions, queries? Councillor Bevan?
Yeah, I think it's important that we attend these conferences, especially the LAP one. I've been quite a few times to the LAP one. I feel if other people want to take the opportunity to chair the vice chair, obviously they should take priority. But if there's a space, I'm quite willing to participate again.
Any other questions or queries? Just on the conference, I will struggle to make that due to other work commitments. So there'll be a space available there for someone.
I would just echo what Councillor Bevan said and really encourage members to go. I've been, I think, 3 times since I've been a councillor. It's really interesting. It's organised by LAP, which is kind of the forum through which the different local government pension funds can work together, particularly to put pressure on the companies that we're involved in to increase, ESG stuff, and it's a good opportunity for networking and talking to other pension fund. So if you can't make it, I would suggest. I know Councillor Bevan wants to go. I'd definitely suggest somebody else takes up that opportunity.
Yeah, so I'll just add that if you're interested in going, if you could just give us an expression of interest maybe by the end of the week, because I think sometimes it does book up quite quickly. So if you're interested, just drop me a line and yeah, we can have a discussion.
Great, thank you. Any other questions or points for Tim on that item? Nope. Okay, well, we'll move to the recommendations as set out at page 101, 3.1 and 3.2. This report's also to be noted. And we'll move on to item 14, pension fund quarterly investment and performance update, providing the PCB with an update of the pension fund's performance for the quarter to the end of June 2024. And I'll hand back over to Tim to introduce that.
Thank you, Chair. So this is the quarterly investment item. It does have an exempt agenda item, which I think might be helpful for us to discuss later, especially based on the discussion we had in the pre-meeting as well with the London Civ and RAFA. But just for the record, just will highlight a few key areas in this report. The first one is just to note the change in the investment value over the quarter. So the fund assets at the moment, or as at the 31st of June 2024, were 1.89 billion. The investment performance is also shown in chart 2, which is based on the benchmark level. So you will note that I have shared another document with you, which is not part of this pack, which we can discuss again in the exempt. But again, it's trying to build up on some of that information that might be helpful for members in terms of informing decision making going forward. Then again, to highlight the funding position, I think we did discuss this quite a bit. It is now 146% as at the 30th of June. So again, very strong, healthy funding position. But again, just to caution that the evaluation is next year. And that is obviously subject to some change depending on how that process is completed. Then there's just a bit around the market commentary, what is driving markets. Primarily, equities seem to be doing well with the world index, and also that the central banks seem to have started easing their interest rates. So the Federal Reserve in September reduced by 50 basis points, or 0.5%. And the Bank of England did that earlier in August as well, to 5%. So that might have implications on the future of markets, but I think there's still a great deal of uncertainty in terms of what that direction is or what that pace will look like from both of those central banks as well. China did as well. Okay, so I don't think in my information, I'm going to have to find from you, Keith, where you find China information so we can incorporate into the report. But 14%. So yeah, I think our EM fund would have done reasonably okay with that. So in terms of investment performance as well, we've just put this on a three-year rolling period. Again, kind of aligned to the triennial valuation. So you can see that there has been the greatest underperformance has been really in index-linked gilts, but that is as expected as rates were going up over that time period as well. So the other thing to include is the asset allocation. This is the strategic asset allocation. And then on table, I think I've coded table 1 again, but I should probably coded something else. There is then the current asset allocation, which presents any rebalancing opportunities. As members will note, there is a bit of a variance in the listed equities, which is just above the allowable range. But I think at the moment, we're waiting until the discussion we'll have later this evening on whether we can action that or not. So that's only explaining why that hasn't been actioned as yet. But under normal course of business, we'd have probably looked for an opportunity to rebalance the portfolio over that time period as well. And then, yeah, again, to highlight, as Taryn touched upon earlier, that we have approximately 78% of assets are invested with the pool, and 25 of those are actually directly managed by the London Civ. So that's all I would like to sort of raise at this moment. Like I said, I think there'll be another opportunities for us to have another conversation on investment performance and investment managers a lot later in the exam part of the agenda.
Great. Thank you very much, Tim. Any questions or queries on this report for Tim? Councillor Bevan?
just a general observation. Noting from other parts of the report, we have 9 separate asset managers and we have 9 separate categories of investment. And I'm aware that the more separate things you have, the more work it is, the more cost it is, the more fees. Steve, perhaps you could just say, is 9 an average or is it below? Because I know there was one local council that had, well, it was Enfield. It had so many, it was completely ridiculous. So I don't quite know where they are now, but, you know, is that too many? Is it?
No, I don't think it's too many. I think you've got a very well diversified portfolio. So over the long term, that should put you in a sort of good position in terms of generating sort of good, healthy, risk-adjusted returns. And a lot of the asset classes and managers that you've had for a number of years now. The buy, maintain credit was the most recent one. I appreciate it can appear a lot to sort of monitor, but I think the governance of the committee and with officers and John, you're also well capable of monitoring these assets effectively. I would add as well, if you've got a complicated portfolio, there maybe is a risk that you make changes too often, and that's where you get costs incurred. But I don't think you make changes on an overly frequent basis, and any changes that you do make are always sort of very well considered, and the cost implications of making those changes are always thought through carefully.
Great, thank you. Tim, do you want to come in?
Well, just to add again to I think to your point, Councillor Bevan. So yeah, there are a number of different asset managers, but in terms of the actual asset classes, there aren't that many. I think there's about maybe 4 or 5, oh not 4, 5 or 6 asset classes that we monitor. So what we're looking to do going forward with this reporting is to put those into sort of separate composites. So for example, in the equities, you've got the MSCI World Low Carbon, but you've also got a multi-factor manager, but that all kind of falls under the brackets of equities. And in the asset allocation, they're all trying to do the same thing. You're just getting further diversification at the factor level. So you'll be able to kind of monitor that based on if we just stack in the main index, how would that perform? So yeah, we'll be looking to do that over fixed income as well, because with fixed income, got 3 different types of fixed income: multi-asset credit, buy and maintain, which is bonds, and then index-linked yields. And even when you not monitor their performance, they've performed quite differently because they're offering you different levels of diversification, even at the asset class level. So that's the view really. So yeah, sometimes it is helpful to have more than one manager. If one underperforms, the other one might be able to provide some outperformance for the fund as well.
Great, thank you. Councillor Ingram.
Can I ask a question about the growth versus illiquid assets versus the protective component of the, I mean, obviously we had made some changes previously to bring the protective element of the fund to 15%, slightly below that now. What do you feel about that proportion going forward?
So I think you've definitely got scope to increase the allocation to protective assets, and the key reason for that is because of the very strong funding level and the surplus that has been reported. So that gives you a number of options to consider. One might be to make changes to the allocation, which provide greater stability in the funding level. Now, the main reason why the funding level is so strong is because the value of the liabilities have come down, because bond yields have gone up. So in very simple terms, the more exposure that you invest in asset classes with bond yields, you'd get some risk reduction. So the size of that risk reduction, a lot of interrelated factors need to be considered. But with the valuation coming up next year, that you're running into the ideal period to start thinking about your sort of long-term investment strategy. But I'd strongly encourage you to sort of consider doing some de-risking, because clearly the funding position is very favourable.
Tim, did you want to come in?
Yes, I think it's actually a question for Steve as well in terms of this. So I think, yeah, the protective assets seem okay, and the illiquid assets as well. Is there scope in terms of what that looks like in de-risking? Because I think we hear a lot of de-risking, and we talked earlier from John's comments around the UK government looking for more capital to be directed. Would there be more scope for that to be reviewed as well in depth in terms of the private markets allocation?
So yeah, there's quite a few issues there, Tim. So just to bring it back down to where you are. So you are overweight equities by kind of 6%. So equities are your most risky asset that you're holding from a sort of long-term perspective, but they're liquid. I think there is a strong case to doing some rebalancing. So that would mean reducing the overweight allocation to equities, and there's plenty of opportunities to reallocate those assets that would be de-risking in nature. So you're a little bit underweight multi-asset credit, a little bit underweight index and gilts. There are some interesting opportunities in property at the moment, and we do think, especially with reducing interest rates, the outlook for property is probably sort of better than it has been. So there's definitely some opportunities to explore there. So that could maybe be considered as a future meeting in terms of actual sort of, possibilities. You've got the sort of the long-term consideration in terms of overall allocation to protection assets. I wouldn't necessarily be looking to make changes to that until the actual sort of formal fundamental review. And then in terms of the government review, so obviously the whole sector is going to be really keen to see what the government does come out with. You're already investing in a lot of the areas that are sort of quite well aligned with the what we think the government is intending to do. You've potentially got scope to invest more in areas such as affordable housing. That's an asset class that we've discussed before with the committee. That would also be well aligned with investing in a more sort of impactful asset, which might be come out of the responsible investment review. Just one comment though on the core Fed evidence and the potential government review. I think the government is likely to have received a lot of feedback in the core Fed evidence about, I think there's a lot of concern in the sector about the extent to which government guidance on investing has an impact on your fiduciary duty. Because with your fiduciary duty, what you need to do is make decisions that generate the required investment return for us on a good risk-adjusted basis to avoid the risk of having to increase contribution rates going forward. Some of the potential changes that the government have been talking about might actually imply that you should be taking more risk than what you are required to. So clearly there's some concern there about whether or not that is appropriate. So I think what the sector is looking for from the government at least is greater clarity on the consistency of fiduciary duty and not being able to invest on a completely unfettered basis.
Great, thank you. That's actually very interesting. That. Any other questions or queries, Steve, or anything else on this agenda point? Nope. Oh, thank you.
Are we going to discuss some of the stuff that we had earlier? Do we get some feed? Are we going to? Yeah, sure. Just want to know what others thought of it. Yeah.
Okay, nothing else on that. Then we'll look to move to the recommendations as set out on page 107, paragraph 3.1, and this report is to be noted. And we'll move to item 15, which is new items of urgent business. Are there any new items of urgent business? No, as there are none, we'll move to item 16, which is dates for future meetings. These are 2nd of December this year and then 20th of March. That's correct, 20th of March, yeah. Item 17 is exclusion of the press and public. Items 18 to 20 are likely to be subject to a motion to exclude the press and public from the meeting as they contain exempt information as defined in Section 100A of the Local Government Act 1972, as amended by Section 12A of the Local Government Act 1985, paragraph 3, namely information relating to the financial or business affairs of any particular person, including the authority holding that information, and paragraph 5, information in respect of which a claim to legal professional privilege could be maintained in legal proceedings. So moving on to item 18 is exempt quarterly investment performance.
Yes.
Yeah, I've done that. Cool. This report provides the Pensions Committee and Board with updates on the pension fund's performance for the quarter to 31st of March 2024. And I'll hand over to Tim again.
Thank you, Chair. So I'll make some initial remarks and then maybe I'll ask Steve if he wants to say some words as well before we open up the conversation. So there are essentially two things to update on here. You'll note in this pack, there is the funding update report. That's just for you to note. And if there are any questions, that's produced by Hymans. And then the second one, you see this pack, which we referred to in the earlier session, which is the quarterly investment performance. This is very much a bit of a draft based on comments from members I've had, I think, over the last few months around understanding the performance better. So this is an attempt of showing what some of the tables could look like. So this has just been prepared to get some of your initial feedback. And if there's any other information that's not included at the moment that you think would be helpful, obviously going forward, you'd add some commentary as to why things are the way they are. But at the moment,